My name's Dave DeBow, founder of MoneyPartnerFormula.com, and this show is built for everyday real estate investors who are actively doing deals and looking to scale using other people's money. So if you're an active real estate investor and you want to get featured on this show to talk about your own real estate and capital raising experiences, then just go to daveinterviewsyou.com. Now let's get rolling with this episode, and remember to subscribe for daily interview content. Welcome back, folks. Hey, let me ask you a question. Are you a middle-aged person with kids that are struggling to get into the real estate market these days because A, property prices are so crazy high, especially up here in beautiful Canada, and B, because interest rates are crazy high and the criteria for qualifying for mortgages has skyrocketed? Well, if you're in that situation and you want to help your adult kids get into their first property, their own home, or into an investment property, today's special guest should be high on your radar because Dion Beg is a mortgage professional. He's also a real estate investor. And today, zooming in from beautiful Pickering, Ontario. Welcome to the show, Dion.
Thanks very much, Dave. Happy to be here.
Okay, give me a quick little snapshot of what, number one, your mortgage business kind of looks like today, who your primary clientele is. And then if I remember, number two would be like, what kind of deals or what kind of real estate investing portfolio do you focus on personally yourself?
Okay, sure. So my background, guys, is I used to be a financial planner. When I looked at the numbers, real estate made a lot more sense. So I've been really deep in real estate for the last 20 years or so. My regular clients, I generally help them on their entire financial journey as it relates to real estate, from first home to getting debt-free, setting up for retirement, and setting up their kids. I think today we're going to be talking a lot about that last one there. And in terms of my personal portfolio, with all those things in mind, we have a small portfolio. I think it's around 16 doors right now. A couple of those have been earmarked for my kids, but don't tell them that. They might kill me in my sleep.
They probably won't be watching my podcast anyhow, Dion.
Not anytime soon. Yeah, so it's been small duplex, small multiplex. And we're lucky enough to own property in Florida as well as in Australia, which is where I'm originally from and why my
I'm thinking I picked up on the accent and the kangaroo gave it away, brother.
That's it.
Nice.
Yeah, hence the name Kanga Mortgage for the company.
Yeah. No, very, very cool. Well, thanks for the update there, Dion. So just want to unwrap something here. So very, very interesting that you went from financial planning. How long were you in that industry for?
I'd say about 4 years.
Here in Canada or in Australia?
That was actually in Australia.
Yeah, because I'm looking up on the wall here. I've got a Canadian Securities Course certificate from 2003.
Right. I think I had the same one way back then too.
When I moved back to Canada after living overseas, I thought, my big brother was a financial planner. I thought, hey, that sounds cool. Until I took that course and understood what mutual funds really are and said, I don't think I'd ever want to buy one of these things.
Yes.
I don't want to make a living selling these things. So I love how you pivoted and how you're kind of providing the same service with a much better asset, which is real property. And I think if you look at your trajectory over 20 years, the kind of returns you've been able to get your clients through real estate compared to what they would have gotten in the market.
It's tremendous. So I'll tell you what made that pivot for me. So I was in my early 20s and I was in a boutique small company. So it wasn't a big bank affiliated company. Yeah. And the owner of the company gave advice on stock market, business acquisition, and real estate acquisition. So I was in a very different type of financial planning company. And what I noticed is these 60-year-olds and 70-year-olds who are our clients, the ones who were exceptionally financially better off are those that own real estate.
They're rich guys.
Always they had real estate in their portfolio, right? And so at that very early age, it was almost like having a time machine to say, okay, if I'm in my 20s, this is in the next 40 years, the decisions you make in your 20s and 30s, this is where you're going to land. So I felt very, very lucky to have that sort of look into the future and say, okay, well, this is going to be the path that I choose.
That's a wonderful perspective. No, that is fantastic. Anyhow, very cool. Just having that background and thinking that through, I'm sure you can look at some of your clients and go, "Ooh, I'm so glad that they did this versus what almost everybody else does with mutual
Correct. And on the flip side, and as it relates to today's conversation,
Yeah.
Some of my referral partners are financial planners.
Mm.
And I literally had a call with a financial planner, a friend of mine recently, where he said, Dion, I wish I'd bought more property. I have a 25-year-old living in my basement. And if instead of putting all my money in the stock market, I'd taken a little bit of that and bought one or two properties, I'd have more money to give to her or a house to give to her, right? So that she could go off and start her life. So that was quite profound, right? Coming directly from a financial planner in today's market.
Yeah, for sure. So we were talking a little bit off camera about the situation a lot of people are in these days. And that is that over the last couple of decades, you've been working with a lot of mom and pop real estate investors, helping them buy single family homes, small multifamilies, rental properties. The last few years, it just hasn't made much sense financially, cash flow wise, interest rate wise, to purchase those kind of properties. But now, if I understood you correctly, a good chunk of those people are have got quite a bit of equity in different properties they have, but now their kids are in their 20s and their 30s, like your financial advisor friend.
Correct. Yes.
They, even if they got a good job, they can't afford to get into the market and buy their own home. So, how are you helping these multi generational families get their kids into real estate?
Yeah, guys. So, I mean, we've always heard about this idea of gifting of down payment or co-signing on a mortgage. But the thing is, whereas before it used to be sort of the exception, it is almost now the rule. Like if
Yeah,
I was to look at the last 2 to 3 years of first-time home buyers who've come through our brokerage, I would say well over 70% of them are getting assistance from family in some way. And it's a function of just the key word being affordability, right?
mm-hmm.
That monthly payment, which is a derivative of what is the price and what is the interest rate, which used to be, under 2 grand, is well and truly above 4 grand in today's world.
Yeah,
And so, how are people now qualifying, and how are they, getting those purchase prices? So, in terms of, and as it relates to parents helping their kids, maybe not everybody's familiar with the concept of co-signing. So I'll just explain that for a
sure.
second. Many people who come to us, the younger people say, "Oh, I don't think my parents can co-sign," or these older people say, "Oh, I don't think I can co-sign for my children because I have too much debt, or I've got a mortgage on my place, or I'm now a pensioner and I can't qualify," right? So the interesting thing is, even if you have pension income, or even if you have a small income, but in some level of debt, in almost every instance, we're able to help those families get an extra 100 or 200 grand by having their parents co-sign, because their parents might make 80 grand a year. They've got a 200 grand mortgage, but they would actually qualify for an extra 200 on top of that.
Mm.
So co-signing is a big way. But on the other
So,
one,
so basically, what people are thinking is that in order to co-sign, I have to be able to qualify for the entire mortgage, where actually it's just we're looking at even if they can help out with a portion.
you
That's how.
got it. And
Yeah.
an extra 100 grand is the difference between a 3 bedroom and a 4 bedroom property,
Mm,
in
mm.
many cases. So that can make or break a deal for many people.
Yeah,
Um,
for sure.
and then on the other side, the gifts for down payment, right? So it's very hard for most people in their, say, 50s and 60s or approaching retirement to think about, oh, if I'd love to give 200 grand or 300 grand to my kids, but what will then be the future impact on me if I need this money in 10 or
Yeah,
20
if
years,
that's a
right?
big chunk of my nest egg for retirement, then what? Yeah.
You've got it. And then the flip side of it is that you don't want to become a financial burden on your family in that time, right?
Hmm.
And so what we've found with real estate is people who have these portfolios, let's just say they have their principal residence plus 2 or 3 rentals. Inside those rentals, they have at least $1 million in equity, right? And so to break off a 200K piece of that million and give that to their kids, yes, it will send them back 200 grand, but the portfolio itself is probably worth 3 million today. And
Hmm.
if that portfolio was just to grow at your standard 5% a year, you're going to make back that 200 grand in less than 2 years, right? With
Wow.
a 300 grand uplift. And so, and this is the other big thing I learned back as a financial planner, Dave, is the maintenance of growth assets in retirement is key to long-term financial safety and security, right? So the traditional financial planning path is you make as much money as you can through your growth assets. Then you get to age 65 and you convert everything to an annuity. And then you live off this set amount of income for the rest of your life. And you protect the cash that you cashed in.
And you hope you die before it runs out.
Oh, yeah. And it's so sad, but it's very true, right?
Yeah.
On the flip side, maintenance of those growth assets, that $3 million in asset
In
with,
property.
with say $1 million of debt sounds terrible and taboo to continue to carry that million in debt in retirement, but it helps you control that 3 million, which now becomes worth 3.3 million in just 2 years from now.
Mm-hmm.
And that is something that I think is a major flaw in current traditional financial planning, which is this idea that we must divest, we must get rid of all of our debt in retirement. I challenge that every day.
Yeah, very, very well said. So Dion, with the clients that you're working with these days, you got the mom and pop real estate investor that over the last 20 years, they built up a little portfolio of their primary residence, maybe 2 or 3 rental properties, whatever it looks like,
Yep.
right? And now they want to help out their kids. And just be blunt with me here, man. Are their kids typically complete doofuses that just don't get it? And mom or dad are trying to get them out of the basement and get them going? Or are mom and dad getting them into an investment property where they're going to be house hacking, renting out by the room, renting out a basement suite, trying to kind of set them up more for success long term? What is that? I'm sure it's all over the place, but what is it kind of?
It's all ends of that spectrum. But I will
Yeah.
say that the majority are children who do want to make a go of it, but just can't do it by themselves. Okay.
Yeah.
So let's just say that they're making 80 grand a year. Okay. Oh no, let's just make it really simple. 100 grand a year, which is above average income. Okay?
That's a very good income for a young person.
So
it really is.
100 grand generally buys you, allows you to borrow about 450 grand today. Okay. So if we take that idea back 10 years, 450 grand would buy you a nice bungalow in the outer ring of the GTA, right?
Yeah.
Driving distance to a transportation but now that exact same property is worth $1 million, right?
Yeah, you might be able to get a condo.
Correct. Yeah. And so that sort of younger home buyer doesn't have the product at the price point that they can allow them to purchase. And so it's not that they're not trying, it's just that they're buying into a very different environment than their parents did 10 or 20 years ago. And so the parents who are smart enough can recognize this and say, look, they won the Canadian real estate lottery. Like these last 15 years have been absolutely ballistic, and we shouldn't ever bank on this happening over the next 15 years. But those who recognize that they won the lottery equally recognize that they're the beneficiary, but their children are the victims. And so they must. I mean, Dave, if you won the lottery, would you give a little bit to your kids?
If they ask nicely.
Right?
And so they behave themselves.
Exactly, right? And so it's like those people who are aware enough to realize that they've won the lottery, they realize they've got to give some of that to their kids right now. And so that's really what they're doing. And yeah, a lot of them are buying their first home. A lot of them are renting out rooms, renting out the basement. Some of them are quite happy living at home, and the parents are happy to have them. And so in those scenarios, what they're doing together is they're purchasing investment property with the children as a stakeholder in the investment property, right? So they'll just continue.
So the children are helping to qualify for financing for the investment property as well.
Correct. And interestingly, the stats from last year are about 15% of investors, property investors, don't own their principal residence. So that's quite a big chunk, right?
Yeah. So 15% of active real estate investors are renters themselves.
Are renters or living at home with mom and dad, right?
I didn't know that. That's a new stat for me.
I think it's a function too of the fact that where prices are, but also culturally, people are single for longer, right? So they're not getting a double income on that application where it used to be at age 25. It's now at age 35.
Wow.
So there's a decade there in which they could go and build wealth, and they've got to choose, is that the stock market or is it real estate? And again, our clients and the children of our clients are going into that real estate path.
Very, very cool. Very interesting. John, this is fascinating. I'll have to have you back on the show so we can talk about some of the other cool stuff that you do with your clients. But in the meanwhile, if people would like to connect with you, find out more, maybe get some help with getting their children, their adult children into their own place, How can people get a hold of you best?
Yeah, just look me up at kangamortgage.ca.
Now, do you work with people across the country or just in Ontario?
Yeah, we do Alberta, British Columbia, and Ontario. And we also do Eastern provinces as well.
Okay, very good. Well,
Mhm.
Dion, this has been a lot of fun. Thank you very much for your insights, and we'll talk to you soon.
Thanks, Dave.
All right, everybody, take care. See you on the next episode. Hey there, I really hope you enjoyed that episode. And as always, if you want to listen to more daily interview content, make sure you subscribe. And if you're an active real estate investor and you're doing deals and you'd like to get featured on this show, then just head over to daveinterviewyou.com. Now, at moneypartnerformula.com, we help real estate investors to create a process for predictably getting capital so they can do more deals without relying on hard money lenders or the banks. We do this by building them a private capital marketing system. Now, if you want help turning yourself into a big money capital attraction machine, then book a call with our team to see how we can help. Just visit moneypartnerformula.com to find out more. All right, take care, and we'll see you on the next interview.